Welcome to the Monetary Mixtape with Will Hoffman, founder of Hoffman Wealth Management. In this podcast, we help fellow Gen Xers simplify complex wealth issues that are important to Gen X. We do this by cutting out the mundane material and using a refreshing approach to finances in a way this skipped generation appreciates. Join us for this ride where we explore financial planning and wealth management as Will Hoffman draws from almost 20 years of experience and brings to you qualified guests to help be your latchkey to tricky monetary affairs.
Welcome to Monetary Mixtape with your host, Will Hoffman, where we talk about the ever-forgotten Generation X. I'm Wendy McConnell. Hi there, Will. How are you?
I'm great, Wendy. How are you today?
Oh, I'm good. And I see we have yet another guest.
We do. To try to compound on our last discussion with Justin Chung, the money dad, and how to raise financially savvy children and pass those messages along. I thought it would be great for us to get some insight into some of our own financial behaviors and maybe learn a little bit about some of the mistakes that we can avoid or that we have made, learn to correct some behaviors that we're making, whether it is from investing, whether it is from spending and standing in line at the grocery store, or when we're making purchasing decisions online. So a few weeks ago, I got to go to Horizon Investments, which is an important ally of ours in our business, and really had the pleasure to meet Alice Heath. Alice is joining us today from Horizon. She's a national accounts manager for Horizon, but Alice has a very unique background and a very unique designation in our profession. And I'm going to let her talk a little bit about that. It's the BFA designation that is becoming increasingly popular and very, very useful for us to work with Gen X clients and understand some of the psychology behind not just investing, but spending as well. So I'm happy to introduce Alice Heath from Horizon. Hi, Alice. How are you today?
Hi, Will. Hi, Wendy. Thank you so much for having me. Very excited to talk about this topic. As you mentioned, my designation is a BFA, which stands for Behavioral Financial Advisor. And basically what that means is I've gone through training on learning the behavior of investors. So learning their psychology, what makes them tick, how do they make their decisions, what affects those decisions. And it's a subject I find very fascinating.
It sounds fascinating.
It is. And it was kind of funny when we met at the conference, Alice and I kind of geeked out a little bit on this conversation to the point where folks would come up, they would listen for a second and say, no, I'm not going to talk to these folks.
Too deep for me.
and it is, as an advisor for 20 years, we have seen all kinds of behaviors, things that make successful investors and successful wealth accumulators, things that we see occurring. And I've mentioned this in the past, advisors' inclination is to, rip open their suit, have the S on their chest, and try to step in front of all of these decisions, whether it is spending, whether it is investing, because we know what it takes and we know what we want to see our clients do to become successful. And through a lot of it is the behavior. It's not the market. The market's going to do what the market's going to do. And the market's going to have times of uncertainty and it's going to have times of great celebration. But some of these things are self-imposed. And that's why I thought it was important to talk with Alice and have her shine a light on some of this for us. So before we do get into the depths of this, Alice, can you give us a little bit about your background and what, led you to the financial industry and ultimately what led you to go after that BFA designation?
Yeah, absolutely. So I'm a product of the industry. My mother is an advisor and has been for over 30 years. So she works directly with clients. My father has his doctorate in economics, so that was always part of our dinner table conversations. Okay. So I always knew finance was going to be the field that I was going to go into. I'm very passionate about it. both from the academic side, but also from I just want to help people, because personal finance is very important. And it's not something that is easily learned. You don't learn it in school. And so finance was always something I wanted to pursue. And then how I got into behavioral finance is an interesting story. Will, I think I mentioned when we met that I spent a handful of years in Ireland, and I got my master's there in financial services. And if you've ever been to Ireland, you know that it rains a lot. And you don't see the sun often. And being from southern Louisiana, where it is always hot and sunny, the weather certainly affected my mood. And I was sitting in a lecture one day and talking about rational investors and rational decision making, and all of this, that classical economics tells you, if this happens, then investors act as if they were rational. And it was always as if they were rational. And with it pouring down rain outside, I was not in the best of moods. And so
I'm not rational.
Right. No, exactly. And so I went up to my professor after class and I said, Prof, this is all sounds great, but we're not rational. Like, that is not how we act. And he asked me, have you heard of behavioral finance? And I said, no. And now this is getting my master's. So I had 5 years of concentrated study on finance, and this was never brought up. And that was quite alarming, because we're not rational.
Right.
We are, in our roots, completely irrational.
Yeah.
That is what has brought us to where we are now. And so I started doing a lot of study on behavioral finance, and I just found it fascinating because it all clicked. It just made sense. And it was a subject that I grew, again, very passionate about. And I mentioned my dad being a professor. So that academic side of, okay, well, I want things to add up. 1 + 1 should equal 2. And when I studied behavioral finance, I said, you know what, this all makes sense. We are people of pattern. Patterns can be studied and learned. And everything I read about behavioral finance, prospect theory, which I'm sure we'll get into later,
Sure.
all these biases, it just made sense. And so I do think it is very important as an advisor to understand this and to educate clients on this subject, because it affects all of us.
Sure. Well, and understanding it is first and foremost for us, because that's why these folks hire us. That's what they want us to help them. And hopefully none of us are saying, well, you should hire me because I know all the good investments, because we know that's a fallacy. You should hire me because our visions match, our values match, and I want to rip open the sport coat and have the S on my chest and say, this is how we help you the best. And it's funny you say the word irrational, because Gen Xers have been through so many irrational financial times. We had, the 87 market crash. We had the .com bubble burst. We had the 2008 financial crisis. We're going through a little bit of some market volatility as we're recording this. So we have seen and been around the worst of times, if you will, that seem to be what we remember and help us make those irrational decisions, rather than remembering, leading up to the .com crash, right, or what happened prior to the financial crisis, or even what happened leading into the pandemic and what the, the markets. So we tend to forget the good, remember the bad, and act irrationally. Help me understand a little bit more about behavioral finance. What types of behaviors do we see that make the best investors, the best accumulators, and quite frankly, the behaviors that advisors are trying to draw out of their clients, so that they can help make these decisions a little bit easier?
Yeah, and I'll first start with kind of an explanation of what is behavioral finance. Sure. It is very generalized. Psychology and finance merge together. behavioral finance attempts to understand and explain actual investor behavior in contrast to theorizing about investor behavior like classical economics, classical finance does.
Okay.
It is about understanding how people make decisions both individually and collectively. And now what brings out, what is a good behavior? Gosh, I mean, I would say it's the hands-off type. It's the trust, of course, as a Gen Y, I will say, or millennial, I will say, trust the process, but
Right.
it's that is the best investor behavior. If you look at the Dalbar study, which comes out every single year, they look at long-term annualized performance of different benchmarks like the S&P or the Barclays Ag Bond versus actual investor behavior or investor performance, and the gap is massive.
It's disturbing, right? It's scary, right?
And it's all really based off of bad investor behavior,
Sure.
which is buying and selling at the wrong time, and we do it all the time. All the time.
And we talked about 401ks before, and what's tragic about the 401k is wonderful of a benefit as it is we're in control.
Yeah.
Our fingers are on the mouse and we're subjecting ourselves to our behaviors, our instincts, our gut. And unfortunately, our gut ends up outweighing our brain when it comes to that, because you can listen to this, you can hear Alice tell you, we're going to go through some of the list of bad behaviors to avoid and understanding them, but you're in control when it comes to clicking that mouse and making that change. And anything you read about ultra successful investors, Benjamin Graham, Warren Buffett, JP Morgan, they still made the opposite decisions that most of us will make.
Yep.
And if we wanted to track somebody's portfolio, I think those three guys are three portfolios and three behaviors who would he be trying to replicate every day. So what are some behaviors to avoid or something to understand when our stomach hurts and we want to make a different decision than what we should?
Yep. As my mom and grandma have always told me, one, nothing good happens after 10. So if it's after 10 p.m., don't do anything and sleep on it.
My dad must have been a little bit of a party animal because he said after midnight, but
Oh yeah.
My mom said dark.
It is sleep on it. Go back to what's the goal? What is your purpose? I think that Gen X actually does a pretty good job at this. Now, going off your previous podcast, how do we pass on good financial behavior and education? Look prior to Gen X. Look at the boomers. They went through the Depression. They might have even gone through some wars. And so their values were vastly different than the Gen Y or the millennials. They were very family oriented. They might not have had much. And so anything that they could save was extremely important to them. And that was important. The idea of having a family, providing for family, that was ingrained in their culture and their values. And that did pass on to the Gen X generation. Gen X, they're self-reliant. They have more of a results-oriented mindset. They are looking for more of a long-term perspective. They have a lot of great brand loyalty.
yes,
They're a little cautious, but I want to go back to brand loyalty because this is where they can get in a little bit of trouble. I mentioned I'm from Southern Louisiana. So Chevron, right? Any oil and gas company, if they worked for Chevron, they're holding that stock until as long as they can, even when they should sell it.
right.
But that brand loyalty can hurt investors. That is what we might say is the endowment effect.
Yes. Okay.
It's you put more value on something because it's yours
Yes.
than what it really is. So the endowment effect
we see that with folks that have, stock plans for their employer.
Yep.
Is when it hits an ultra high, no way am I selling that. And when it hits a low, they always say, well, it's coming back.
Yeah.
So they have that endowment bias. And then I think the other one that plays in there is anchoring, right? Is that the anchoring bias? What's going to come back?
Yeah.
And their entire, retirement or their entire net worth is tied to one name. Mm-hmm. And it's kind of, I hate when folks refer to investing to, they make gambling references, but in this instance, it's almost like refusing to get up from the blackjack table when you know that you should.
Absolutely. And we were talking about Chevron, you mentioned a stock portfolio. That is what kind of the Gen X grew up with was, hey, do you have a hot stock tip? Yeah. Right. And it was word of mouth.
Right. That's that .com era where you could throw a dart at the Wall Street Journal and make a few bucks quickly because, that rising tide lifted all ships in the late 90s.
Yeah. And certainly we saw the rise of technology, or at least the beginning of technology with Gen X. But I like, a lot about Gen X from a financial planning standpoint is they relied on you guys for the expert. You were the expert. They went to financial advisors for information, whereas the younger generation, at a click of a button on our phone, we have all of the information that we could want at our fingertips. And it's really hard to connect with that generation because we think that, well, we're the experts.
Right.
That's not the case. And so kind of going back to what I was talking about previously, the values that have been passed on, the Gen Y, we grew up with a fairly stable household because our parents were value driven, and the importance of having a good nest egg and providing for children. Those values were really high up on that list. For millennials, it's all about experiences. It's about the next thrill. It's about instant gratification. And that's really tough. And, it's not a great generation to try to connect with from a financial standpoint. And so for advisors, going back to, hey, we got to trust the process. I'm the expert. Let me help you with your 401k. Let me help you with college savings. Let me help you with buying your first home. That's what you kind of have to focus on.
Sure.
Biases are almost inflamed, right? They are growing and growing, and it's going to be tough to really lure them in and help them, because that's what we're ultimately just trying to help.
Now, in a lot of our conversations, while we do a lot of investment work for folks, probably an even 50-50 split. A lot of the reasons why our clients will reach out to us in the middle of the process, or really they call us in the first place, is when it comes to spending their money. They've accumulated, and now it's time to, whether it's buy a second home, whether it's time to start spending on an education for their kids, spending, and maybe the perils of overspending end up creeping in as another litany of financial biases and financial behaviors that we need to be aware of. We need to be aware of when we're doing it. Especially with how easy it is to spend on a whim. It doesn't require a drive to a store anymore.
Yeah.
It's again, more clicks of the mouse that, everything's on its way by the time we think, oh, maybe I shouldn't have done that.
Yeah.
So do you see the same types of behaviors in spending creep into individuals and into consumers?
Yeah, I think you're seeing that more so now with the likes of Amazon and being able to order things online. I think creating a budget, sticking to it is super important. one thing that at least credit card companies have caught on to, which is good, is anyone can go on to their online statement and actually get a breakdown of exactly what they're spending their money on. And if you're spending money on retail, you can see that. And it's just learning how to, one, acknowledge that, okay, I can go back and track my monthly spending. What am I spending my money on? And going back to aligning it to your values. Is it something that you want? Is it something that you need? Does it align with your values, which is something that during the BFA, you do learn how to align values and goals with how you spend money. And if you can do that, and you need a financial advisor to hold you accountable, that's going to be one way that you can kind of curb those bad spending behaviors. Is they call it in the BFA course, freeze game. Freeze. Does this spending align with one of your values? Yes or no? If it doesn't, should you reconsider? If it does align with your values, then run it by your financial advisor. But I think aligning spending with values will ultimately really help you stay on track with not overspending that nest egg, because people are living a lot longer.
Sure.
It's got to stretch.
Yeah. Well, and that's the conversation we have with our clients. You know, I can't look at you like a 45-year-old. I have to look at you as a 92-year-old.
Yeah.
And are we not eating, baked beans out of the can when you're 92? That becomes the mission, is to, make sure that, and that's our obligation as advisors, because we want them to think that long term, but they're not always, because there's the next vacation, the next big expense. If you have kids, there's always next big expenses coming up. So baseball season just started, so we've been
$100
bats and gloves. And I told my dad the other day, there's no way that in the 3 years that I've been buying baseball equipment, there's no way you spent this on my brother and I's entire youth baseball experience. We played a lot of baseball when we were kids. There's no way you spent this on our entire youth baseball experience, what I've spent in 3 years for one kid. Luckily, there's a younger brother that he can hand everything down to, but it's crazy what these things cost. I shouldn't say crazy. It's a sign of the times. My dad was probably complaining about how much my baseball glove cost in 1988. So it's just a sign of inflation and things getting more expensive. It is funny when I look at these lists of biases and behaviors, how many are common between investing and spending. When you have, the emotional and excessive, you have loss aversion, you have confirmation bias, sunk cost fallacy, all of these things that are, and again, those are terms that we may need you to familiarize ourselves with, but they're not just with investing, they're also with spending. What's the tie in there?
So whenever I think of spending and biases, the first one that comes to mind is confirmation bias. And confirmation bias is essentially the tendency of people to favor information that confirms or strengthens their beliefs or values with someone else. So for example, I think we talked about this, Will. I'm into fitness.
The cold plunge, yes.
Love health. I wanted to buy a cold plunge. And you guys can Google that to learn what that is. And so instead of asking my mom, hey, do you think this is a good idea? What did I do? I asked my other friends who were also into health, and they said, oh, yeah, you should definitely buy it. Now, thankfully, it also aligns with some of my values, but where you see confirmation bias is when you want to buy something, say you are retired, you really want to buy that car. You talk to your buddies and they say, yeah, man, you should definitely buy that car. That would be so cool. Think about driving down Coastal Highway.
Oh, it's the worst sounding board.
Yep. But if you ask maybe your wife, hey, babe, I'm thinking about buying this Corvette, she's going to say, absolutely not. That's not in our budget. So confirmation bias where you ask your friends who are kind of agree with you to give you that confidence to say, yeah, this is a good idea. You see, I see that a lot happening, which again is why it's really important to have a financial advisor.
Yeah.
Not just to say, hey, no, not to be that you're killing my fun, but to just say, hey, do I have enough money for this? Can we budget for it? Is it something I can afford now? Or Will, you might say, hey, that's awesome. I know that you love taking road trips. That's what you said you wanted to do in retirement. Prices are a little high right now. Let's see if we can budget. So in 6 months or in 1 year, we can afford that car comfortably and you won't have any regret about it.
Yeah.
And so certainly when it comes to spending, be very careful who you're asking for advice, because you're going to ask the person's advice who will agree with you.
That's always my dilemma as a financial advisor is, and I'm saying this tongue in cheek because I love Corvettes, is telling somebody, no, you shouldn't buy a Corvette would be really, really hard for me to do. Mm-hmm. But we got to do it. Yeah. It's our job is to do the hard stuff.
And you bring up a good point. Just because you're a financial advisor doesn't mean you don't have these biases, or you're not affected by biases. You absolutely are, but you are a little bit less emotionally detached from some of these decisions, where you can be that sounding box or that
you can probably line up your values with the purchase more easily than somebody who's not
that's
in finances.
It's also the important thing of having a plan that's always running in the background, because we can easily show them, yeah, you may be able to afford this Corvette, but this is what it looks like when we remove this money from your plan to replace it with a depreciating asset.
It's so not fun.
And no, it's not. It's a buzzkill. It's a buzzkill. But you're right. Having the plan allows that to say, yes, the number on your statement says buy the Corvette. Mm-hmm. And it's the devil on your one side of your shoulder. Mm-hmm. And the plan is the angel on the other side that's saying, wow, did I just go back to what was a cartoon? Like Tom and Jerry always had the devil in the but Alice.
Oh, I know Tom and Jerry.
Okay.
And the Roadrunner.
but the the plan is the angel on your shoulder saying, remember, this is what we're here for. Yeah. And if the Corvette's the goal and we have it in the plan and we're trying to accumulate for the Corvette and it's time. And it's why it's also, they get called emergency funds and they get kind of a negative connotation. Should maybe also look at it as an opportunity fund when that trip that you've always wanted to take is now an option, when the car you've always wanted to buy is now an alternative. Mm-hmm. Those things need to be communicated and worked in the plan so that we are enjoying our life. Because, and there's one bias or behavior that I don't think we realize we're doing as it's occurring. And it's lifestyle inflation.
Yep.
That as we start to get promoted, as we move into the C-suite, as we start to have those, the stock options available to us, our life starts to tick up in its price tag. And we join the country clubs, we buy the cars, we upgrade the house, and all of a sudden we've accumulated, but we don't have more wealth.
Yeah.
And all of a sudden we're like, shoot, what happened? And we got all the stuff, but we don't have the wealth, and we're going to still be working when we're, in our 70s or 80s, and nobody wants to be doing that. So I guess what are some tips, some things that we should be doing other than listening to the Monetary Mixtape that will help folks anchor their behaviors so that they're making those decisions and their stomachs don't hurt as bad when the market's down, and they don't, fall victim to the euphoria when things are going good?
Yeah. I mean, diversification, it's been pounded into our heads forever.
Right.
You need to stay diversified. Long-term investing. That is not something that my generation does, because we do want instant gratification, and it's like squirrel and we're on to the next thing. But long-term investing will absolutely help us stay the right course. Setting very clear goals and objectives working with a financial advisor can certainly help you start to put pen to paper. And I'm not saying that metaphorically. Science and psychology has proven time and time again that if you actually write something down, you are more likely to stick to it. If you go to the grocery store, I still write out a list of exactly what I want. And if you go to the grocery store without your list, you're going to end up with a bunch of stuff that you're like, oh, I really didn't need that.
Right.
But just simply writing down your goals, writing down what you want to do, that is a nudge, a cognitive nudge that will absolutely help us stay on course. And then I would say, anytime you get nervous or you get excited, anytime your heart rate is thumping, take a step and sleep on it.
Mm-hmm.
That has always been advice that I've taken, and being part of the generation that is very impatient, that is one that is hard to overcome, but you almost have to be your own angel voice.
Yes.
That will help.
And our generation is notoriously independent. For Gen Xers or entrepreneurs was the word that Cam Marston used back in our early episodes. And if I can do one commercial for my industry, it is work with a professional, because it's hard for us, being as independent as we are, to hear conflicting advice from a professional. But your doctor is going to give you great health advice. Mm-hmm. Your dentist is going to give you great dental health advice. Your attorney is going to give you good legal advice. Your accountant is going to help you do tax planning. Your financial advisor is no different than any of those other professions. The industry has been cleaned up so much with some regulatory changes that now we are giving you, not selling you a financial product, but we are giving you financial advice that will help you in your wealth accumulation phases and in your retirement planning. Alice, if there's something we should have talked about and didn't yet, what's that?
I think what drew me to behavioral finance from a practitioner standpoint is, as investors, as humans, we are our worst enemy. We do make the wrong decisions at the wrong time, and it is catastrophic. It can be catastrophic. And I'm not talking about you climbing the tree a little too high and falling off and you break your arm. That can be healed in 6 months. But I am so passionate about helping people, because finance, I mean, it's one of the main causes of divorce, right?
Mm-hmm.
It is. This really matters to families. And if you make the wrong choice at the wrong time, which we still do today, that can have a lifelong consequences. And so, sure, we can get into the academic of behavioral finance and, prospect theory, which says investors value, gains and losses differently, because we do. Losses hurt twice as much as gains feel good to us. And we can understand the cognitive implications of why we have these biases. Working with an advisor ultimately will help you prevent making a mistake that has effects that could last 20 or 30 years. It can affect whether or not you can send your kids to college. Will your kids have student debt? Will they ever be able to save? And so I think a point that I want to just really nail in is, you should work with a financial advisor to help you make the right decisions when they are desperately needed.
Mm-hmm.
And that is not which investment is best. It's actually, which decision should I make when it comes to buying and selling whatever that underlying instrument is. A financial advisor can help you make the right decision that is needed if you want to, which I think everyone's goal is, to retire comfortably and not have to worry. And I really applaud you, Will, is that is exactly what you're doing. And it is so important. And you are helping every single one of your clients. And I hope more people will use a financial advisor for those reasons.
Well, and it's fortunately for me, it's a fun mission. It's I never feel like I work a day. If folks want to learn more, how do they get in touch with you? What are some resources that you would recommend? I think I have a sneaking suspicion as to an author that you would recommend them reading, because we're both a big fan of him, and we're going to work to get him onto the Monetary Mixtape here soon.
Yeah. Well, if you want to do more research and you are between the age of 35 and 45, go to Google and type in behavioral finance. If you are a little more old school and you like reading an actual hardcover book, look for Daniel Kahneman or Amos Tversky. They actually won a Nobel Prize in economics, which is quite rare because they're both psychologists. Those are the godfathers of behavioral finance, and everything that they talk about is certainly fascinating. If you want to have a chat, feel free to reach out to me, 704-919-3609. But yeah, the internet has a lot of really good research, and it's fascinating.
Yeah, and you're active on LinkedIn too. They can connect with you there.
Connect with me via LinkedIn, Alice Heath. I work for Horizon Investments, so you can find me there.
Awesome. Well, thank you so much for joining us, Alice. Thanks for all your insight. I know that these are things we're applying every day with our clients, and maybe if someone hears this and can rethink a decision before it's too late, or try to correct the behavior so they can start their their wealth accumulation. And like you said, these are the things that we can't stress enough. They're very, very important to setting your family on a different trajectory. The counters to these behaviors cause debt. They can cause financial stress in lives. Alice is spot on. It's the leading cause of divorce. It is important to listen. You're right. I am passionate about it. I think that's why we, talked about it for so long in Charlotte a few weeks ago, and why as soon as we spoke, I said, I got to have you on because it's great insight and great information. If you have any questions for me, very active on LinkedIn, feel free to reach out. Find me as Will Hoffman. I do appreciate you all listening. If you do have any questions, I look forward to hearing from you soon. Wendy, do you want to take us home?
Well, I would love to. Well, thank you both for being on today, and thank you for joining us. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Don't bounce just yet. The street lights haven't come on. Thank you for listening to the Monetary Mixtape Podcast. If you thought this episode was dope, then click the follow button to be notified when we drop a new episode. Visit our website at hoffmanwealth.com or give us a call at 724-522-5411. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Hoffman Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Hoffman Wealth Management are separate entities from LPL Financial. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.